Hey everybody, this is Kevin Day here. I'm with the Business of Making It. It's thebusinessofmakingit.com. That's my website. We started a little blog, me and my wife, where we write articles and post videos and slide decks like this about starting a business. We're both in the process of starting our own businesses, and we thought we could, provide some advice. I have a accounting and tax background. I've worked in public accounting for over 6 years now, and hopefully I can provide you guys with some support and also with just some useful tools that you can use in your business. Today I'm focusing on the Synergence model with LipSense, and hopefully you guys can get some good little nuggets out of this, and we can all learn a little bit. So here we go. Our course objectives today, we're going to be going over entity selection. So I'll go over the different types of entities that we have. We're going to go very briefly over that. Entity selection can get really deep and really bogged down, and I don't want to confuse anybody today, so we're just going to go briefly over that. I'm going to give you some quick tips on getting started, just some basic things that I think are essential in getting started. Then we're going to go over some basic accounting, some terminology, and also just kind of help you guys account for all of your business income and expenses. Then we're going to go over documentation for these income and expenses, what the IRS is expecting us to have as documentation for our income and expenses. And so we'll go over that. I'll go over briefly the difference between sales tax and income tax. I know there was a few questions out there for that, and so we're going to go over that. And then I have a couple common misconceptions at the end that hopefully can clear up some things for everybody out there. All right, so first up, we have entity selection. A majority of you guys out there and a majority of small businesses are going to be sole proprietorships. This means that you are operating the business as yourself. You do not have a separate entity that's operating the business. You're just kind of running it out of your house. You're running it as an individual. And so that's what a sole proprietorship's called. If somebody asks what you're running your business as, you tell them a sole proprietorship. This means that you're going to report your income on your individual tax return. So when you file your tax return at the end of the year, you're just going to attach a little schedule. It's called a Schedule C, and that's going to be attached to your individual tax return, and it's going to report all your income there. And that's going to be how you report your income for tax purposes. The other three have different tax implications, have different legal implications. They're set up differently, but you want to get into those when you start making a little bit more money. When you're around $10,000 or $15,000 in income over a year, then you might want to start looking at the S corp, LLC, or partnership. Talk to your tax advisor. Talk to somebody you know that can help you out with these questions, because, like I said, they have a bunch of different benefits, and it's important to know the difference. We're not going to get into those today, but I just wanted to let you know they're out there, and maybe when you should start looking into them. So tips for getting started. The number one that I would tell everybody, and it's amazing how many people don't do this, get a separate bank account. You're going to want a separate bank account. It's so much easier to track all your expenses, your income. You're not having to dive into your personal bank account and say, hey, was this a business expense? Was this personal? Was this fee, was this income that came in? Was that something I sold for LipSense, or was it, so if you just have a separate bank account that you run all business income and expenses through, it's going to make your life so much easier. I can't stress that enough. You're not going to miss any deductions. You're not going to miss any income because it's all flowing through there. Next up, almost equally important, you're going to want to buy some accounting software. So there's different types. There's QuickBooks Online. You can buy the actual software that you download on your computer. I recommend QuickBooks Online for almost everybody. It's very easy, very user-friendly. It's going to be very simple. And later we're probably going to post some videos about QuickBooks and just kind of how it looks and all that stuff. And so that'll be useful. But for the time being, you want to get it. It's pretty user friendly. You guys are going to be able to work around with it. QuickBooks Online is what I use, and I would recommend that to all small businesses. It's a great way to go. You're going to save money come tax time. So as a tax preparer, I can attest to you, when somebody comes to me with a box of receipts or a bunch of bank statements and a box of receipts and an Amazon statement that shows everything they've purchased, I'm going to charge you more money to prepare your tax return. It's a little bit more of a headache for me to have to go through all that and create my own kind of income statement, where QuickBooks will actually just take all of your transactions and it'll make an income statement for you. It'll have your income, expenses, everything laid out perfectly on one page. You give that to your tax preparer, and heck, your fees are going to go way down. So it's going to save you so much time. It's going to save you money when you're paying for your tax prep fees. And so, yeah, huge. It's going to help you stay organized and track your income. With QuickBooks Online, it actually links up with your bank account. And you can just, the transactions will come in and you'll just say, okay, this one was supplies, or this one was income. So I sold some product. It's going to move to income. So you're just going to categorize every little transaction that comes through your bank. It keeps it, it just helps you stay organized and keep on track. It also does it fast, right? So we're not wasting a lot of time entering it in Excel or something. It's really easy. And if you have a separate entity, if you've already reached that point, or if you're going to in the future, this is essential. You really need it because it helps you have a balanced balance sheet. It also helps you have a good income statement. I'll kind of go over those those terms I just used a little bit later so everybody can understand. Next tip: review your accounting frequently. You don't want to get behind. If it's not daily or weekly, you need to be doing it at least monthly. Get in there, categorize everything. You don't want to get too far behind because then you get a little down, and it starts to become a pretty big burden to get caught up. And so I would always recommend review your accounting frequently. Get into it, do it a lot. Okay, so then the last thing, we want to track your inventory. I know a lot of you guys are using Square, or if you're not tracking it at all, use Square or use Excel. And I know there's some helpful videos out there in helping to track your inventory, but you want to use Square, Excel, something to track your inventory. You want to know what's coming in, what's the value of the products that you're buying. If I buy 10 lipstick and they were all $10 each, I'm not sure what the prices are, but if they were all $10 each, you have $100 of inventory in your store. So you want to make sure you're keeping track of all that stuff, different prices of all the different items you're buying, and how many of each do you have. And so we want to track it. We want to use Square or we want to use Excel. We want QuickBooks also has a inventory tracking system, but it's usually a little bit more expensive, and I don't recommend it for smaller businesses. So use Square or Excel, some kind of thing where you're tracking your inventory. And then we're going to move on. So basic accounting for your business. Like I said, we're just going to go over some basic rules here. Revenue, I'm pretty sure everybody knows what that is. That's the money coming in. So any money coming in, that's going to be revenue. The most common revenue for LipSense people and for the Synergence people. You're going to have your sale of your product, and then you're going to have recruiting revenue. So everybody you're bringing in to work under you, those are going to be kind of your two types of revenue. And then we have your cost of goods sold, which is the cost of the product that you're selling, right? So you're going to have other expenses. You're going to have supplies. You're going to have postage when you're sending things, shipping, gas mileage, travel, right? You go to different seminars and stuff. The stuff for cost of goods sold, we're looking at the actual cost of the product that you purchased and that you're going to sell, right? So that's the cost of goods sold. That's what that term means. We're going to go into that a little bit more. And then you have expenses, and that was everything else I mentioned. So you're going to have travel expenses. You're going to have meals, you're going to have postage, all that stuff. Those are going to be your expenses, and then that gets you down to your net income. So I made a little formula over here. You have revenue minus your cost of goods sold. It's generally referred to as COGS in the accounting world. So you're going to have your COGS. It's going to take out and get you to gross income. That's going to be your gross income number. So it's going to take your revenue minus your COGS, gross income. Then you deduct your expenses, and then that gets you down to net income. That's the number that's important to us because that's the number that's going to be reported on our tax return at the end of the year, how much income we made. That's the number we care about, net income. Other than that, we're going to move on. I think I go into these topics a little bit more here. Okay, so first off, we're going to talk about cost of goods sold. Cost of goods sold, this is just a little snip that I took out of the Schedule C that I referred to before. It's going to track your cost of goods sold for you on your tax return. So that's why I was saying it was so important to keep track of your inventory and the value of your inventory. It's going to come in handy when you're filling out this form. Included in your cost of goods sold is going to be the purchase of your new product, and remember, track your inventory. And then also some other miscellaneous things. I don't want people to get confused here, but materials and supplies. So anything directly related to your product that you're selling. So if you're like wrapping it in something special, or there's some kind of attachment to the product that you're selling, you'll put it here. But for the most part, it's just going to be basically the product you're selling. So the lipstick or any other stuff you guys are selling is going to go in here. You're going to track your purchases. You're going to track the end of the year balance, what you have at the end, and then that's going to give you your cost of goods sold. That lets us know what was your change in balance of your cost of goods sold over the year, of your inventory, sorry, and then that'll give you a cost of goods sold number. This is kind of confusing for most people. It's confusing for some accountants even, and so trust in your tax preparer, trust in your your accountant that you might be referring to, or that you might be going to prepare your tax return. Trust in them and just keep those balances. You want to make sure you're tracking your inventory. All right, and then we have expenses. Remember, these are different than the cost of goods sold. So buying the product is not an expense, that's a cost. Expense, we're just going to go touch on this briefly again. So this is everything that's not COGS. So everything that's not cost of goods sold. Advertising, accounting fees, meals. And these are only certain types of meals. You can't just deduct every time you go out to eat, right? So we'll go into those a little bit. Supplies, postage, travel when you guys are going. I know there's a lot of seminars and a lot of events that you guys can go to for Synergence. Yeah, deduct that travel, deduct the hotel stay, deduct the plane ticket, whatever you're doing, deduct those expenses. Those are definitely deductible against your income because it's to help your business, right? Business mileage. So this is the only thing you're going to have to track separately. You can't track this in the QuickBooks software. So if you're tracking this, you want to track some business mileage. So little known fact, I'm just going to send out a little nugget to everybody here right now. If you're going to the store, let's say you work out of your house, you're going to the store to buy some packaging or whatever you're doing to buy for your product. You go to the store and you drive there, and the store is 2 miles away. You turn around, come back, it's 2 miles back, right? You keep track of those miles. You keep a log. What day did I go? How many miles did I drive? That's probably sufficient. So you have what day, how many miles you drove. For every mile you drive, you get a 54 cents of a deduction. And that's huge. I know it doesn't seem like much, but add that up over an entire year, ends up being pretty big. And so, and if you do the calculation in your head, 54 cents per mile is a lot more than what gas costs. And so you're getting a big deduction there. So like I said, that's the only thing you're going to have to track kind of separately because it's not going to flow through your QuickBooks account or anything. You're just going to track it on the side, and then you'll give that to your tax preparer at the end of the year. So documentation, I just touched on it a little bit with travel. I mean with business mileage, but the documentation needed to track income and expenses. The IRS understands that it's kind of an administrative nightmare to keep every receipt that you buy, whenever you buy something, or every little statement that, they understand that that's going to be difficult and a burden and too much paper, right? You just have too much stuff. So I'm going to leave a link here below that'll give you some IRS documentation guidelines, but most common documentation, you're going to have invoices. So if you guys are sending out invoices to your customers for when they're buying, keep track of those, right? Keep track of those invoices. If you use QuickBooks to send out invoices, it's going to keep all that for you on QuickBooks, and so very easy to track. You don't, like I said, you don't have to keep all of these things. These are just some of the examples of how you can track your things. Bank statements, so bank statements will work. So if everything's running through your account, if you're not using cash, right? If you're just using your bank account, bank statements are sufficient for tracking most of your expenses. Receipts, so if you do use cash, keep the receipt. If you don't have a receipt and you use cash, if you get audited, you're not going to be able to take the deduction, basically. Or canceled checks, right? If you wrote a check and then you can print out the check, usually from your online banking account, you can print out like a copy of the check. So those are just a few documentation that you need, and we're going to go into a little bit deeper with some other types of expenses that require a little bit more documentation. So documentation for meals and entertainment. So it's perfectly allowable to deduct the cost of a meal if it is business related, and I'll kind of go into what it means to be business related. So this is on a separate slide. This is important. So IRS wants to discourage people from abusing this expense. So it could be very easy for me to go play golf or to go take my friends out to eat and just run everything through my business account, right? So it's really easy to do that. I could just, every time that expense comes into my QuickBooks, I just mark it as meals and entertainment. It's very easy, but the IRS discourages that. So not only meals and entertainment is going to be automatically limited in general to 50% of a deduction. You don't have to worry about that for your accounting. Just classify it as meals and entertainment. When your tax preparer takes your statement, he'll automatically take 50% of your meals and entertainment. So they're going to limit the deduction. So there's been abuse in the past, so they're going to limit the deduction to 50%. So don't get too crazy with this. In general, your meals and entertainment expense is limited to 50%. There are instances where it could be 100%, but they're not very common. And for this business type, I don't see that being very often. So let's not worry about those. Requirements. So you need to have documentation of the expense. So a receipt. You need to have who attended the event. So who was there? You literally have to have the names of the people that were there. So you write down the names of everybody who was there, and then you have to have a business purpose. You have to write on the receipt. If you have a log of some sort that you're keeping track of these, you can have an Excel spreadsheet that's keeping track. But you're going to have a log, or you just have to have a section that describes the business purpose. If you write it on the receipt, you can do that as well. You just write it on the receipt. But I have to have a business purpose. If right before you guys go to dinner or right before you take out a potential client, you're taking them out to some entertainment, maybe take them to a movie or whatever, as long as you had a business purpose right before or right after, or you're recruiting new people, right? Sometimes that happens. You're recruiting new people and you want to show them a good time, maybe to recruit them. You're gonna have to have a business purpose either right before or right after, and then just document it, and you should be good. Like I said, this one's kind of a hassle just because people have abused it in the past, and so they're trying to correct that. It's a little bit of a hassle, but you can get some deduction out of it if you stay with it. Okay, so sales tax. I know a lot of people had questions on this. The difference between sales tax and income tax, we're going to go through a little bit later, but sales tax, do you need to collect sales tax when you sell? It depends. So SeneGence is collecting the sales tax from its sellers. So when they sell you product, they're collecting the sales tax and they're remitting that sales tax. When I say remitting, I mean they're giving that sales tax they're submitting it to the state and the local government, right? So they're taking that sales tax and they're giving it to the state. If they're doing that and you haven't elected out of that, just keep with it. You don't need to, you yourself, when you sell the product, you do not need to collect sales tax because they're doing it in that transaction. You don't have to. The reason why they do this, it's a more of an administrative burden on their part if they're having to collect sales tax from every single seller. So instead, they'll just collect the sales tax from Senegence at the first level, and then when you guys sell it out to your customers, you're not going to have to worry about it. You don't have to collect the sales tax. If you do collect sales tax and you are collecting sales tax, you must remit those taxes to the state and local government. And you just need to look up, because every state's going to be different, how to do that. You need to look up how to do it. Because if you're telling your customers you're collecting sales tax and you're putting it on the price tag and you're not giving that money to the state, you're basically committing tax fraud, right? So this can result in penalties and interest, and even if it's really, really, really abused, I'm talking thousands and thousands of dollars, it can even result in imprisonment. So serious stuff there. Everybody, if you're collecting sales tax, you need to remit it to the state. Now, I said it depends at the beginning because you can actually tell Senegence that, hey, I don't really want to pay the sales tax. It's adding to my cost. I'd rather just collect the sales tax and then remit it myself to the state. So there's a form you can fill out, and I will attach in the link below here. We'll put a link to that form that you can fill out and give it to Senegence. And you can fill out that form and tell them that you want to start collecting it, and then they will stop collecting sales tax from you when you buy the product from them. This can save you some money. You're not going to have to pay that. So that's 8%, anywhere between 6 and 8% that you're saving every time you buy. So you kind of got to weigh the benefit for you, right? How much money are you saving versus how much time it's going to take you to collect the sales tax, keep track of it, submit it to the state government. So if you're not having a ton of sales right now, you probably just want to leave it up to Senegence. Even if some people would rather just, hey, I'll pay the 6 to 8% and let Senegence do it and not worry about it. So I can't be clear enough on that, guys. If you're collecting it, you need to file. You need to file it with the state. If you're not, and you're just letting Senegence collect it, then you don't need to collect sales tax when you can even promote that, right? I'm not collecting sales tax, no sales tax when you're selling. It's a good selling point as well. Okay, so now we're going to go into sales tax versus income tax. A lot of people had a question about that. So sales tax is not the same thing as income tax. When sales tax is collected and remitted to the state by Senegence, or if you've elected, you could be submitting it as well. And it's charged on the sale price of the product. So as we sell the product, it's generally like I said, between 6 and 8%. The sales tax is the amount that we're paying. We're generally paying Senegence the sales tax, right? So we're paying Senegence the sales tax. That money is given to the state. That's a totally different term, a totally different idea than income tax. So income tax, so just because you're paying sales tax to Senegence does not mean you do not have to pay income tax. You still need to report the income, and you still need to pay income tax. So income tax is paid when you file your individual income tax returns by April 15th each year. That's that special holiday for all us tax people out there. So you're going to be paying on your net income. So you're going to take out all your expenses, your cost of goods sold. What's my net income? I'm going to have an income number, and that's what your income tax is going to be based off of. So this is charged on the net income of your business versus sales tax, which is actually charged every time you sell or every time you're buying from Senegence. They're going to take the sales tax. If you've decided to collect sales tax, you're going to charge it every time you sell it. Hopefully I didn't confuse people there, but there's a difference there. You have two different types of tax, and they're both going to be applied to you in a different way. And so just wanted to get everybody on the same page there. It's two different things. Okay, reporting your income. If you have a business entity set up, like we discussed before, I discussed them briefly. So an S Corp, LC, partnership, then you'll have a separate tax return than your individual tax return that you're filing with your spouse or by yourself. You're going to have a separate income tax return, and generally these are a Form 1065 or a Form 1120. If you don't have those, we're not going to worry about it, right? So we're not going to worry. All income and expenses will report it on a different form, and it's going to pass through to the individual. If you're a sole proprietor, which I'm thinking most of you are, you do not have a separate business entity, and you're actually just going to be reporting this income all on a Schedule C that's going to be on your Form 1040 that you file at the end of the year for your personal income taxes. I'm going to have an example of what this looks like down below. I'll attach the form. I'll give you a link to that form, and it can kind of show you what that form looks like, so you guys know what you're going to fill out. If you're preparing your own taxes, you can fill it out. TurboTax, if you're using any of those tax software, you can just, they'll help you fill out that form. And as you get to start filling out these things, as your business is growing, and it seems like this is getting a little bit harder than you think, you might want to think about getting some tax help, get a tax professional to prepare your return, because it starts to get a little bit more difficult. People get a lot of notices back when they're preparing and they're not adding up things correctly. And so, like I said, you just want to make sure once you grow, you want to start maybe get some tax help. Okay, so we had another question that came across, how much to set aside for taxes. So the U.S. tax system, as most of you know, is very complicated, and there's a lot of things that go into how much money I should be withholding or setting aside to pay eventually to when I have my, when I file my tax return, I owe taxes. So the U.S. tax system is progressive, and how I mean about that, or what I mean about that, if you look at these little brackets on the side, so if you're single or married, you have these brackets. So for example, I'll go with the married bracket here. 10% of, or there's going to be a 10% tax rate on the first $0 to $18,650 that I make. So out of those first little bit of dollars that I make, it's going to be a 10% tax rate. And then as my income goes up, the tax rate goes up. And so it doesn't necessarily tax all of your income at the same rate as you move up, but it does tax those new dollars. As you're making more and more dollars, those new dollars will be taxed at the higher rate. So like I said, this is kind of a hard question to answer, but my safe bet is 30%. If you're setting aside 30% of your income, your net income, so that end number, if you're setting aside 30%, then you should be okay. All of your earnings are going to be subject to another tax called self-employment tax. So because you're self-employed, you're not paying payroll taxes. You're not being paid through like a paycheck, which takes out the Medicare and all that stuff. We are subject to self-employment tax. And so that's another 15% added on to whatever percent you're in. So if you're married and your spouse is making money, take into account their income, whatever their salary is or whatever their projected income is for the year. You're going to add that to whatever you think you're going to make, and then that's what bracket you're going to be in. And so you want to withhold that plus the 15%. So sometimes it can be higher. A safe estimate would be 30%. If you want to get some expert advice, get a tax professional to help you, and they can, it'll usually cost money, but they can help you know exactly how much you want to withhold, because they can do some projections and kind of get you in the right spot. But tough question to answer, but I think a safe estimate, a safe bet would be if you withhold 30%, you should be good, and you should be safe. That's kind of the safest way to go. Okay, so last slide here, some common misconceptions. I've heard this before. I'm only taxed on the income when I take it out of the business. You got in quotations there, take it out, right? So that doesn't really exist. right? So whether the money stays in your business account and you never actually move it over to your personal account, it doesn't matter. You are considered to have earned it when you earn it, right? And so when that money shows up into your business account, you're taxed on, after taking out all your expenses, of course, but you're taxed on all the money that your business makes, minus all the expenses that you have. And so, but don't get fooled by weighing, oh, okay, once I take the money out of the business, then I'll be taxed on that money I take out. No, that's not how it works. You're taxed on everything. I don't need to report my income on tax return because Senegence is collecting tax when I buy it from them. So that was kind of one of the questions we had. And honestly, this is a huge misconception. It's totally understandable to have this question, right? But this gets back into our sales tax versus income tax. So remember, you're going to have two different types of taxes. You're going to be paying sales tax when you're buying the product from Senegence, and you're also going to be paying income tax when you file your tax return. Two different taxes. But that's basically it, guys. I know you're probably going to have a lot of questions. Like I said before, accounting and tax, I know it pretty well, and we're going to be around to answer some questions. If you have questions, you can post on the Facebook page with the group. And post them there, and we'll get to you as soon as we can. And yeah, if you have any questions specific to your industry or to your business, yeah, just post some questions there, and we can, or kind of general questions, and we can answer them for you. If you need any expert advice, go on over to my website. It's on that first slide there. The business of making it.com. You can go on there and you can get in contact with me there. And I can give you some more deeper advice if you are, you're making a lot of money and you're just wondering, hey, I need some help with this. I'm more than happy to help. But yeah, so here we go. I hope this was helpful for everybody. I hope everybody got a lot out of it. And I'm excited for you guys and excited for your businesses. Hopefully you guys are doing well. And hopefully we'll be in touch. And I will talk to you soon through the posts or let me know if you have a question. Okay.